Let's talk about the individual. How is the individual affected by what happened in Washington?
I'll handle that.
Okay.
Yep. For the individual, the first benefit obviously was that although they maintained the amount of tax brackets, the tax brackets were reduced, where the highest tax bracket is 37%, down from 39.6%, but that's for high-income earners. The individuals that don't earn as much, the threshold on where their brackets go to a higher level was increased. So for the middle class or lower income earners, just on the tax rate, they'll have more money in the pocket on a weekly basis. Their withholdings that are taken off their check will be reduced, so they'll be left with more money in their pockets. And this we shall see now in February when the new rates are implemented. There will be a revised paycheck from that day, so people will see the benefits right away. So that's a significant benefit. Another significant benefit is that everybody talks about itemized deductions or standard deductions. What's itemized deductions? What's standard deductions? Although the government allows you to take certain deductions on your tax returns, for instance, if you're paying a mortgage and there's an interest, or you have to pay interest, the government lets you write off the interest portion. Or if you give charitable contributions, or you pay state taxes, these are all deductions. Or you have medical expenses. There are a certain amount of deductions that the government lets you take. However, you don't have to choose to take those deductions, or as called, itemize those deductions. What you can do is the government lets you take what's called a standard deduction, regardless of if you actually had those deductions or not. Prior to this law, the standard deduction was a little under $13,000 for somebody that's married filing jointly, and for somebody that's single filer, it would be about $6,300, a little more than that. Where the government says, here's a freebie. Even if you don't have any mortgage, you don't have any interest, you don't have charity, here's a freebie, you can deduct or take the standard deduction. The new law had increased the standard deduction taking as an example a married filing jointly. It went from a little under $13,000 up to $24,000, which means if you earn $50,000 or $60,000 a year, the government lets you knock down. If you're married filing jointly, the government lets you knock down $24,000 of it, and your tax is not even calculated yet. Your tax is being calculated on whatever is left after the standard deduction. So by increasing the standard deduction, this can make a huge difference for the lower income earners, which will be evident in their paycheck, because their paycheck takes this into account. Their paycheck takes into account the tax rates and the standard deductions. So there'll be more money on a weekly basis in people's pockets. There is, however, certain changes in the...
Before we get into changes that are on the negative side, there's one more positive side, and that is the government, on top of the $24,000, gives you another break. For every child you have, you get a $2,000 credit. In other words, if you have, for argument's sake, 4 children, first you get a $24,000 standard deduction, and for the 4 children, you get an $8,000 credit, not off your income, but off your tax. So if you made $60,000 and the tax on the $46,000 or the $36,000 would have amounted to $5,000, and you have 4 children, you don't have to pay any taxes either, because
right off
the tax, not as a deduction.
It's not the full $2,000 is not refundable. It's refundable up to about $1,400 would be the refundable.
The difference between a credit is you get off the tax. Now, if you have no tax to pay, and you have 4 children, and there is no tax, so you can't use the $8,000 credit, the government will give you 4 times $1,400 in cash back as
Wow.
if you're getting you're not paying taxes,
Right,
but you're
but-
getting a refund. In that case, it would be $5,600 you would be getting. So that's another plus to what the government did. And the last and final plus,
Just in this note, there was, however, the exemption that was knocked out, which is that the government lets you exempt a certain amount of income based on the amount of based on the children dependents that you have or that you're filing. That was done away with, but they felt that by doubling the standard deduction to $24,000 and giving the child tax credit, it should make up the difference. A couple of other points just to mention.
Maybe
and
about
move
mortgages.
quickly. Yeah. So as you know, if you have a mortgage, you're allowed to deduct the mortgage interest portion. Before this change, the limit on the interest that you can deduct is on the up to $1 million of mortgage, meaning interest that you pay up to $1 million of mortgage, that interest can be deducted. In addition to that, you were able to deduct on if you had a home equity loan with interest of that loan, $100,000 of debt. The interest that you pay on the $100,000 of debt, that would have been deductible. So the changes that they made sort of brought that down, which is not necessarily a benefit in this tax law, which is that right now the limit is you can only deduct on mortgages for balances of up to $750,000 instead of $1 million, and on home equity loans that would not be deductible.
But I think it's grandfathered. That's only for new mortgages that you take. I think that we have to check whether mortgages that you have in existence.
I
So many
believe so.
details.
I believe so. Yeah, a couple of other small things. If somebody gives a lot of charity, where the government let you deduct up to 50% of your charity, right now that's going up to 60% of your charity. So if somebody is very charitable, they can give even more charity. The only bad part of this or downside is for the high tax states such as New York, New Jersey, California.
Illinois,
the high tax states, in theory, those residents of those states took a hit because previously you were able to deduct your state income taxes that you paid, which could be a significant amount of money. And right now the IRS is only putting a limit of up to $10,000 a year, so
including property taxes.
Including property tax. So if your state and local taxes in total was $30,000, you're only able to deduct up to 10. So right now those states are actually dealing with these issues, and it is becoming a little controversial on how they intend to go about it. But
recently I heard an interview with Secretary Mnuchin of Treasury, and he was asked the question that some states want to turn the property taxes into a charitable deduction. In other words, call it charity.
Right.
You're giving charity to the state so they can deduct it. And he said during this interview, he said that the IRS will not allow it because it's not charity. It's property taxes duly owned on property, and you can't call it charity. Even though the law doesn't preclude that right now, but I'm sure the IRS is going to put it into their regulation.
The argument is that you have to level the playing field, and why should the non-high taxed or no tax states have to, in theory, subsidize those other states? But then you can argue that the higher tax states are usually more highly populated,
right?
So
and they're higher value.
and
in most
so they're
cases,
sort
the
of
property
contributing
value
a
is
big
higher,
chunk of the revenue. But
so
hey, this is a back and forth that we'll have to deal with.
Any final takeaways for the listeners of Mind Your Business? I'm first going to pose it to Saul and then to Simeon. Any final takeaways?
They tout that you will be able to file your taxes on a postcard. It is true. Most people that take the standard deduction have a couple of kids, postcard size, nothing else. But for the small businessman, and that's a topic we're discussing today, or shareholders in a small business, or partners in a small business, until laws settle in, it's very complicated. And I urge you to sit down with your professional, with your accountant, with your tax advisor, and go through these various topics and see how you can take the most advantage of the tax cuts that were enacted by Congress, and that should boost your business, and it'll give you back some of the money that you've been paying will remain in your pocket and in the pocket of your business and of the employees, and the economy is going to roar as it roars after every tax cut.
So, Simeon, you anything or you ditto that?
I sort of ditto that, but then again, you have to do research, but understand that conceptually you should know the basics, understand the basics so that you know when to ask questions. So that everybody should do, is do a little research. But at the end of the day, you should rely on a professional so that you can be sure that whatever decisions you make are going to be the correct ones.
If somebody has any general questions, and if they can forward us by email or send it to you, and you can forward
What
us.
email address?
Our email
That'd be
address
info.
is
Info
at snfco. That's Sam, Nancy, Frank, Charlie, Orange.com. We're going to try and get back to you just with general
General
answers.
questions.
And we really enjoyed this. And,
Thank you.
And you must be, in your prior life, you must have been an accountant, because you really asked a lot of tough questions.
Well, we do a lot of preparation before each show, but a very special thank you for making it so easy for me because of your knowledge. I love the honor of interviewing C-level executives and sharing their great advice and perspective on Mind Your Business. I'd love to get your feedback. Post it in the comments below and subscribe. You'll never miss an edition of Mind Your Business.